Inflation numbers, 8.5%. What is your general thoughts, takes on the numbers that we're seeing today?
I mean, 8.5% seems pretty cheap, if we're comparing it to Miami and $25 drinks in the club. I mean, come on. So I saw you guys down there. That was a fun time. I mean, yeah.
Two waters were $20. I got two waters, these little Fiji things that live, two of them, $20, $10 each. I was like, you're out of your damn mind. But then I bought two more.
Yeah, that's how they get you. I mean, I think honestly, CPI is understating that. You guys have been saying that for a while. I've been saying that for a while. These are the government statistics, but still, I mean, it's accelerating. A lot of people, the same people that have been calling for a top in the, accelerating inflation month over month numbers. This time around, I've been saying that the last 6 months or so, it'll be interesting to see if we get somewhat of a kind of a crush of demand as some of these things continue to soar like energy. Obviously, some stuff like food demand is inelastic, and people just need it to survive. So you're seeing a lot of really kind of crazy stuff happen with, say, wheat and agriculture around the world. That's really interesting to keep an eye on. But I mean, in terms of just real yields and a deeply negative state of basically every yield in the entire global bond market, that's accelerating, and that's the biggest story in finance today.
And what percentage of this do you think, if any, has to do with what's happening in Russia and Ukraine when it comes to an inflation perspective, right? We've seen the White House has said that a lot of this has to do with Russia and Putin and all of the sanctions and whatnot that have been placed on him. Do you think that we're seeing that in the data yet, or do you think that's to come in the following months?
Yeah, I mean, it's definitely a role, but I think just to call it Putin's price hike and completely ignore the fact that you had politically enforced lockdowns of the global economy, printed a bunch of money, destroyed supply chains, and then said, okay, yeah, this inflation's Putin's fault. It's somewhat gaslighting and straight propaganda. And anyone that kind of believes that is I don't even know what to say there.
You're searching for the name. I can see your head spinning and the steam coming out of it. But we get what you're trying to say. So you sent us a bunch of charts, which we appreciate. So let's maybe start with the 10-year versus the 10-year Treasury yield year over year versus US CPI. What are you seeing there?
Yeah, so put out a tweet about like an hour ago and said this is the most important chart in finance. Kind of what I'm referring to when I'm talking about the state of real yields. U.S. Treasury market's basically that risk-free rate for the global economy, and it's essentially what every asset in the world is valued off of. The story of 2022 has been, in the bond market specifically, especially on the short end, has been just the drastic rise in yields due to this inflationary environment. Right, every fixed income holder realizes that they're sitting in contracts guaranteed to lose money, so they sell it off. The value of those bonds goes down. The yields go up. What you're seeing in credit markets and really every single like equities, everything else, every asset market is basically duration, which is basically how these assets are priced. Right? You can think of duration as the lower yields are, the lower that discount rate is, the more that these assets will be priced off of like high multiples. So when those yields rise, it's basically that duration of the asset goes down and the value of it goes down as well. And so that's what we're seeing. And that's basically why you're seeing every single asset kind of trade in tandem, Bitcoin and the NASDAQ, everything else. We have graphics of that because it's all about the USD denominator at the moment. This is basically, reflecting the liquidity tide.
So as that chart starts to compress at some point, right, if they raise interest rates and inflation starts to fall on a year-over-year level, what impact does that have on the market from whether you want to talk about risk assets or whatever, just generally, what impact does that have?
Yeah, I mean, the story is, even if it somewhat compresses, I really think the story is that the 40-year real yield bond bull market was shot behind the shed in 2020, 2021, maybe 2022, if you want to call it that. But I really think it happened post-COVID, where you could just sit in treasuries, you could sit in bonds, and you could basically just ride this wave of ever lower yields and a lot of things, demographics, debt, and globalization let these kind of inflation levels never see anything, higher than 4 or 5% since the 80s. And so this was just basically a very, very good environment for financial assets, and for, specifically because of our world reserve currency status, the US. And so if we're seeing that trend shift, which a lot of people, like, this is a very big picture idea, but a lot of people are, there's pretty big implications for that. And I think the biggest losers of all of this are the creditors, the bond holders, the people that own these debt securities.
Gotcha. And one of the other charts that you sent over was the U.S. 10-year secular trend that you had mapped out here. What are you seeing in this chart?
Yeah, same idea. We don't have the CPI numbers here, but essentially this, I think Raoul Pal calls it the chart of truth. A lot of people kind of follow this, and this is mapping out a lot of things, but debt and demographics being the biggest. And what's not shown here is that with every kind of boom and bust cycle, with every credit cycle that we've seen, about 8 to 10 years, give or take, we come out on the other side with far more debt at the federal level, at the household level, at the corporate level. Aggregate debt to GDP globally, and this is somewhat of an estimate, is around 400%. So we just can't handle higher yields, even if it's deeply negative in real terms, adjusted after inflation. In nominal terms, the financial system breaks at a certain point, whether that level's 3, 3.5, 4. We don't know, and we'll see what we get to. But there's going to be a breaking point in the bond market as these yields soar, just because of how over-indebted the global economy is. Like, this is the macro picture right now.
And when you say the financial markets or the global economy just breaks, right, at some point, I assume you're talking to some degree about the bond market, which you mentioned. But what is the outcome for like the average retail investor in this scenario?
Yeah, so essentially, when you talk about the system breaking, what you have in this monetary system, this economic system, and why you kind of see these financial crises occur, right? In 2008, yeah, subprime mortgages are bad, but why did it tank the global economy? It's essentially because you have fiat-denominated assets and liabilities. And during bubbles and during kind of credit expansions, you see the asset-liability mismatch. Everybody borrows, invests in assets, and the asset side of their balance sheet goes up. And it's kind of self-reinforcing. Everyone feels richer, you reinvest, assets continue to go up, you take on more debt. But when that trend reverses and all of a sudden you have more liabilities than ever, and because of rising yields, because of inflation, because of just, say, a global pandemic that tanks productivity, what happens? Well, the earning side of your balance sheet goes down. One person's earnings or one person's spending is another person's income, and it's reinforcing on the downside. And all of a sudden now you have a huge asset liability mismatch, but the bad side. And so what happens is, well, you have an asset liability mismatch. You sell what you can to pay down your liabilities. And it's just a cascading event where everything kind of, the house of cards falls down. And so we're not there yet. I mean, I'm not calling for the end of the world, but this is why these credit, expansion and credit contractions, this is how they work. Fiat money is destroyed through debt default or repayment. And so when you have kind of these mass default events, these mass insolvencies, right now we're kind of in the liquidity risk environment. What that eventually leads to, if central banks and governments don't kind of step in and help remonetize a lot of this debt and inflate people's balance sheets, is what happens is that liquidity risk turns into solvency risk. And that's when kind of it turns into actually systematic risk for the fiat itself.
Hey you, did you like this video? Great, we make 5 of them a day and post them here on this channel. Make sure you're subscribed, like the video, and see you next time.